Hi, this is Proact Sam with this episode of Living and Working Abroad show. Thanks for joining us today. We're looking at the possibilities for wealth tax, not just in the UK but around the world. Something under active consideration at the moment, and with the changes in the UK and the potential for a budget in October targeting raising taxes not on income but on capital and on wealth, and specifically aimed at non-DOMs and expats, then it's time for big changes and big considerations and big decisions to be made. We can't and don't know what's ahead in the budget, but we can try and preview with you and enable you to make the best decisions. At the end of the day, when you make a tax return, the UK taxman will make the assessment and decide what tax you're going to pay. We can't do too much about that before then. We can only make our best judgments to organise the assets of family and business living and working abroad in the most cost-effective way for yourself. Let's start this week by just highlighting another photo shoot for the Keir Starmer government. We've seen that in the UK it's very much Photoshop presentations of images that are PR managed being released, and in a press conference earlier this week we saw Keir Starmer announcing and confirming that he won't increase in his October budget income taxes VAT within the UK. So that's income taxes, but it doesn't affect anything else. He's also said quite clearly that he will tax people with the broadest shoulders, i.e. the richest or the one with most assets, and also they specifically said they'll be targeting non-DOMs. At the same time, they're committed to nationalising large chunks of British industry like the rail service, so that's going to take capital as well. So things are going to change, and you can do some anticipation. If there's a budget in October and the changes are made immediately, then there's not a lot you can do by making any capital or other movements after that date. It's very unlikely, and not a tradition in the UK, that changes are made retrospectively, but it doesn't mean that they can't do them. What they are committed to doing is changing them by April next year. Under the current Finance Act, we know what the taxes are through to April next year, but they could be changed and new taxes could be introduced in October that apply for the rest of the current tax year. This has been the pattern with British governments over the last few years. We're not having a political bias here. Over the last 20 years, Labour, Conservative and Liberal governments have all connived to change the taxes and increase the amount of taxes on capital and property and investments for UK expats, and with a dominant government in power now, able to apply their will, having been voted into power, they can make a diktat of what they think the way is forward. And if you're a political animal at the start of your 5-year term, you want to get the most out of it. So now is the time for you to act, and that October budget is the one where the changes will come in. At Proact, we advise people living and working abroad. We're a family office, so we look at managing the assets across border and down generation. Let's look at one distinction where people often make a mistake in the distinction between what your domicile is as a tax residence. It's being used a lot in the build up to the budget about non-dom and domicile status, and some of these changes have already been enacted by the previous government in anticipation of the changes that were being brought in. A tax residence can change from year to year, so if you want to change your tax residence, Proact can help you do that, and you can go abroad on a short-term contract for 1, 2, 3 years and earn that money abroad. If your commitment and your intention is not to be long term, then the UK can still retrospectively tax you when you return to the UK. So first of all, you've got to have the intention to move abroad. The second thing is where is your permanent home? So if you leave your family in the UK and your permanent home in the UK and you go to live and work abroad, then there's every reason why the UK could say, well, you know, we're still going to tax you based upon your permanent home being in the UK. The reason being is that in tax law, domicile means where you're from. So that could be where you're born, but it could be where your parents are born. So you could be born of British parents abroad, but still be deemed to be British due to your domicile of origin. It's an important factor, and if you are a British expat with children born abroad, you might want to consider getting them a UK birth certificate to assert their domicile and residency and citizens' rights in the UK going forward. If an expat comes to the UK that's not a British citizen, the old rules said that they were deemed to be non-domicile for 15 years. Now, the current Labour government had said they will change that. It's already been changed in the last budget by the Conservatives in anticipation of this change. So now, if you're an expat coming to the UK, you're only considered non-domicile for 4 years. Now, it doesn't affect your tax residency. What domicile affects is your liability to inheritance tax. So if you're domiciled in the UK, you've got a liability to inheritance tax on your worldwide assets, even if you die abroad. Even if you've been abroad for 20 years and you're selling UK assets or you're dying, then you've got that potential liability. And that can be traced back through property ownership, bank account ownership, pension ownership in the UK, including the state pension. So in our connected world, where there's exchange of information between all financial institutions and the government, a government in power and can behave autocratically and make rule changes to the law to suit their purpose and their elected objectives. So this is what we're looking forward to see, what the changes and how far they will go in terms of non-domicile. So an expat moving to the UK, after 4 years, they're then liable for tax on their worldwide dividend income, interest income, inheritance tax, even if that's arising in another country. Similarly, if you're a UK expat living and working abroad, then you potentially got this tie because your domicile of origin is the UK. People can go to countries like Cyprus and declare themselves non-domicile, so they're paying 0% tax in Cyprus on dividends and interest, and there's no inheritance tax in Cyprus, so that can be a very attractive proposition. But if the UK change the law, or if they imply their assert the domicile rights to British citizens of origin even when they're abroad, then potentially they could claim dividend tax, interest tax and inheritance tax and capital gains tax on their worldwide assets. An expat could leave the UK and not necessarily pay capital gains. So you could leave the UK and then not pay tax on your capital gains. It's not as simple as that. You can't put your house up for sale and then plan to leave the UK once the sale goes through and not pay the capital gains. It's what your intention is always the key point, and it's something to bear in mind when you're anticipating this. Already some of the loopholes have been changed on capital gains tax, but it is possible to leave the UK and then potentially have some capital gains that are not taxed. It's a deferred taxation for 5 years and then it drops off for expats. Now that could easily change and change in the next budget. If you've left the UK before that budget, then there's a potential for you to change your circumstances. But for more information and guidance on relocation overseas and taking tax residency abroad to start the journey to change your domicile, contact us at proactpartnership.com. Bear in mind that while there's no exit tax in the UK at the moment, there is in the USA. So there is precedent for this in other countries around the world. So if a USA citizen goes expat and takes their capital abroad, they will be charged a lifetime inheritance tax or capital gains tax on the assets that they're exporting. There is lifetime inheritance tax in the UK at 20% already, so it's very possible that that could be extended to a broader brush approach to people relocating overseas or overseas people disposing of UK assets. 20% at the moment. Inheritance tax is quite high in the UK, 40%. We could see some changes on that. So non-doms could be attacked in the budget. For more information and guidance, changing your circumstances, especially if you're already expat, to change your position of your assets, prior to a family office, and we can make arrangements to give assets into protected environments free from tax changes in the future in the UK or abroad. So let's have a look at the possibility of a wealth tax. At the moment, the G20 nations around the world are actively considering the introduction of a wealth tax. There aren't many countries with a wealth tax at the moment. The only countries that apply a wealth tax are Spain, Switzerland, and Norway. However, there are other countries around the world introducing these little taxes. So Portugal, for example, even if you're an expat, but if you're a Portugal resident, if your earnings are over 80,000 euros from within Portugal, there's a 2% solidarity tax at pay, which is a form of a wealth tax. Other countries around the world as well have these little tax on everything. So there's a potential for a wealth tax to be introduced. So let's have a look at a bit more history of wealth taxes in the UK. So there's two types of wealth in the world. One is income tax, and the other one is capital gains taxes. Now, capital gains taxes didn't always exist, the same as income taxes. And income tax was introduced in one stage, but 300 years ago. But capital gains tax was only introduced in 1964 by the Labour government. But it's not a construct of Labour exclusively. In 1988, Nigel Lawson, Margaret Thatcher's Chancellor, introduced some radical changes on the basis that, under his understanding, capital gains tax and income taxes were pretty much the same and that have no negative effect on the economy. So if you're applying, the reasoning is, if you're applying a capital gains tax or an income tax, they both are a tax on the economy, so one of them is not going to be worse than the other. So you can have income taxes or capital gains taxes. The thing was that they introduced capital gains taxes as well as income taxes, but the initial intention was the capital taxes to apply when income taxes didn't, and from there it just got complicated. Now, the one thing that was allowed is that if you bought a house for £10,000 and owned it for 50 years and it went up to £100,000, there was an element of inflation in that price rise. It wasn't just a capital appreciation, it was inflation price rise. So capital gains tax was charged on the real gain, not the inflated gain. So that was an important distinction. So if you're in inflationary times and the property price goes from 10,000 to 50,000, there'd be no capital gains tax to pay. But if you sold it for 100 because of the capital appreciation, you pay the capital gains on the difference between the 50 and the 100,000. So that's all very well until Gordon Brown came along 20 years later and abolished indexation on capital gains tax. So now we have this situation where if you buy a property for 100,000 in the UK and you sell it for 200,000, you pay your capital gains on that whole gain. So you're stuck with it. Whatever you make in cash terms, you're going to get a cash capital gains tax, and that is a bit unfair. Now, if you want to start changing and radicalising capital gains tax, as we're looking at and examining at here, one thing to make it look good for the PR for Mr. Starmer's government is you could reintroduce inflation indexation for capital gains, at least to make it a fair tax. And the thing is that inflation proofing, if it was introduced from from the time of the next budget, it wouldn't have an immediate impact on the tax take they're going to get in the next few years. The impact will be in the longer term. So it's something that could easily sell to reintroduce the index linking, removed by Gordon Brown. But even so, capital gains tax has got much more complicated in the UK. There's a basic 10 and 20% rate, depending on whether you're a basic or high rate taxpayer. But then property is different, it's 18 and 24. Income tax rates are 20 and 40. But inheritance tax is also a capital gains tax. So on death, all your capital gains are wiped out and you just pay 40% inheritance tax. So again, they could go either way on the tax changes. They could reduce the top rate of inheritance tax down to from 40% to 24%, the same as the capital gains tax, or even to 20%, or they could increase all the capital gains taxes to 20 and 40%. So align capital gains up with income taxes, so you've got 20 or 40% for income or capital gains, whether it's on investments, property, or business. You're always going to pay that rate. Not forgetting there's also an additional 45% inheritance income tax rate. Now, so they're not going to change the income tax rates 20, 40, 45. So they could increase the lowest capital gains tax from 10 to 40% at the higher rate. So it could double the rates for capital gains tax on investment and business. Properties wouldn't actually be as much, but it would still be an increase that would affect those that are going to get the assets from the investments and the savings that they've done over the years. Now, you could let's just be fair and be clear that they've committed to maintaining the personal private residence relief, so the family home will remain free of capital gains tax. That's a commitment that's been made in Keir Starmer's garden party this week for his Photoshop. But even so, for expats living and working abroad, if you've got a property and you're expat, is it your permanent home? Is it your permanent residency? If you're not domiciled to the UK and you're outside the UK for more than 4 years, are they going to allow you to still get that capital gains tax relief as a personal private residence? It's not automatic even now. And one thing is for sure, is that if you've got any rental periods for that property, then it can impact you quite severely. Just have in mind that where your permanent residence is a definition of your income tax liability and your tax residence. So if your permanent residence is in the UK while you're working abroad, then still potentially you're liable for tax on your worldwide income. So the UK could simplify or change the rules, align them more like the USA, whereas you're more firmly tied as UK domicile to UK taxes, and there's less freedom to relocate overseas and get capital-free gains and dividends and interest that's not taxed, a source in the UK. As a family office, ProAct would offer family and business ways to protect those capitals in private arrangements, not with third parties, controlled by the family, but protecting them from capital and inheritance taxes in the long run cross-border and down generation. For more information and guidance, contact us at productpartnership.com. If I can mention now just a little bit more on the detail of private residence relief. If you've got a family home in the UK and you lived in it in the UK, at the moment you can sell that and it's capital gains tax free. Now, if you go abroad and you're not and you become non-domiciled to the UK, then potentially you could be not have a liability to inheritance tax in the UK if you die. However, a property and residential property in the UK is a fixed tax tie to the UK. So if you rent property in the UK, if you sell property in the UK as an individual, then it is taxable at your highest marginal rate. So at the moment, property sales in the UK are taxed at capital gains of 18 or 24%. Your property rental income is taxed at 20 or 40% or 45% in the UK. So there's potential for that to increase quite rapidly going forward. If you go abroad and you maintain an empty property, there's a case where you can argue at the moment that it's your principal private residence in the UK and entitled to relief. However, if you look at the double taxation treaty, wherever you're living with the UK, it will always say the decision on making where your tax residence is made based upon where your permanent residency is. So maintaining a home in the UK, which is not your permanent residence, means that you can be a tax resident in another country. So it'll be very easy for the UK to change the law to clarify the principle that if you want to argue that you're going to get a personal private residence capital gains tax relief on a UK property, then you must be tax resident as well, and that will be a way to block expats owning a capital gains tax free residential property in the UK in the long term. Even so, if you start renting it out, then they're going to start taxing you. So you've got a certain period of time where you can sell it. Generally in the UK, if you're buying and selling, you've got 9 months to buy and sell it. So that's the general principle. But potentially you've got capital gains that are going to charge you every time that an expat tries to sell a property in the UK. For more information and guidance on protecting property in the UK from higher rates of tax, you can contact us at productpartnership.com. So let's have a bit more of a look at wealth taxes. Wealth tax is an issue. I think that really is an opportunity now for this autocratic democracy that we've got in the UK at the start of its 5-year run to introduce a wealth tax. They've got the overwhelming majority that can dictate the agenda for the next 5 years. So at the start of their 5-year term, if they make the changes now, it gets time to go through the storm. They've got the parliamentary majority to enforce that, and then let things settle down so people come comfortable with the new reality where everybody will be equal or more equal than everybody else. And wealth tax is an area in the UK where it could do that. So we're moving on. We said earlier that there's a difference between domicile and tax residence, and the non-domicile status is going to be changed so that the tax status and the non-residency status of UK expats around the world or in the UK could be changed quite radically in the budget. And then if the UK introduces wealth tax, this has got potential to be applied on a tax residency basis or on a domicile basis. And it could be an effective way of raising some additional revenue. For example, the value of UK property is about £87 trillion. So if you introduced a 1% tax on that 87 trillion, you'd create £87 billion of tax revenue. So the using the PR playbook list the new government have come up with, they found a black hole in the finances, a black hole that was already there, a struggling growth economy with not enough tax revenues to pay out the public expenses. So they want more money to spend, and they're looking for 20 billion. So a property tax of even 0.25%, a third of a percent on the value of each property in the UK could plug that hole and be an additional tax for anybody owning property in the UK or owning wealth, because you could apply that just as easily to an investment fund, a bank account, or a pension fund. Already there's potential for pension funds to be taxed in certain instances, so they could be added into this wealth tax as well, into this inheritance tax regime. If we look at inheritance tax as a specific tax, what's the possibility of them changing the rules on that? It's an effective tax, and it's a big earner in the long run for the government, but it doesn't make a short-term impact. So there's no positive or negative to increasing the rates at the moment. However, they could get some good PR if they change the rate. So if they were aligning the tax rates, the inheritance tax at the moment is a flat rate 40%, which is quite high. So why not introduce two-tier inheritance tax at 20 and 40%, so that the smaller estates, say under £1 million, only pay inheritance tax at 20%, and it's only the larger estates that would do that. Obviously, if you're living in London and you've got any sort of, or the South, and you've got any sort of reasonable house, your house is going to come under this rule. Inheritance tax applies to a UK domicile person, whether their tax residency is in UK or abroad, and it applies to their worldwide capital, including the UK. If you're non-dom, it only applies to your UK capital. So you need to consider quite clearly how they're going to change this. We're looking at simplification of tax and capital gains tax and wealth taxes to raise taxes overall, but sell it in the playbook to be a good thing. So you could introduce a two-tier inheritance tax to bring it in line with income taxes, 20 and 40%, or even 20, 40 and 45%. So slightly, in effect, complicates inheritance tax, but aligns it with the income tax rates. So therefore you argue it's simpler and it's not increasing income tax. And potentially then, by putting the maximum rate up to 45%, you can increase your inheritance tax in the long run. At the moment, somebody dies, any capital gains that you've got are wiped out, and you only pay inheritance tax. So at the moment, you could pay a capital gains tax of 10 to 24% on assets if you sell them while you're alive. You don't have to pay that when you die, you just have to pay 40% inheritance tax. So a really mean approach would be to apply capital gains on assets being disposed of before you pay inheritance tax as well. I think that's a complication. I don't think it's likely, but what I think is more likely as a simplification is to say that inheritance tax is 20, 40 or 45%, so it's aligned with income tax, and then just make the bands the right amount so that it's going to impact those that can best afford to pay. Capital gains tax, let's look at capital gains tax now. Or not. Let's look at income tax. In the UK, there's 34 million people, and my notes are useless here, so forgive me there. Let's look at income tax before we look at capital gains tax. In the UK, 34 million people pay income tax from working or from savings or other income at the moment. That raises £250 billion a year, which at about £7,000 a head. So the average income tax bill for a person in the UK is £7,000 a year. Now on capital gains at the moment, there's only 370,000 people paying capital gains tax at the moment at an average rate of each hit of £39,000, and it's raising about 14 billion. So you've got 14 billion being raised on capital gains and 250 billion being raised on income tax. Now Nigel Lawson's idea was there's no difference between a capital and income tax on the economy, which is true. So if you can apply capital gains to more taxes where people are paying no income tax at the moment, then it should be neutral to the economy and still allow the economy to grow. If you apply capital gains where people are already paying a higher inheritance tax and an income tax as well, then that's going to have a negative effect. But at the moment, if you can go after gaining more capital gains, anything up from the 14 billion towards the 250 billion, then suddenly you can start filling your black holes and filling up your bank account, so you can go nationalising businesses and increasing pay for public sector workers. Don't forget we said that the value of UK property, not the investments, not the businesses as well, but just the property, real estate in the UK, 87 trillion. So a 1% wealth tax would generate £87 billion, so it would more than plug the gap and make capital gains up to 100 billion tax. Not as much as the income tax, but a significant amount of play money for the government to change the way that the UK is run. The G20 are looking at wealth taxes at the moment, and it's been promoted quite strongly by Brazil, who are leading the G20 at the moment. It's an international proposed scheme. They're actually looking for a 2% tax in terms of wealth tax, but as with all things, they'll introduce tax at a lower rate and it'll build up towards that. So it's a 2% solidarity tax in Portugal. The G20 are looking for a wealth tax, discussions around 2%. The new UK government have got the opportunity to consider a wealth tax, and even 1% of property values would generate them 87 billion. So 1% of property, business and investment assets in the UK would generate them substantially more. Even 0.25% of property, business and investment assets would generate more than enough to fill the black holes, make the public investments they want, and then even start cutting taxes by the end of their 5-year term. So that's what the potential is. But internationally, although there's only 3 countries with a wealth tax at the moment, there are more rolling them out, and there's a potential in the future for more of those to be applied. For more information and guidance on wealth taxes and how they may affect you going forward, contact us at porrectpartnership.com. Porrect is a family office. It means we want to protect a family's business, property and investments cross-border and down generations. And the way to do that is to make sure that you've got a good approach in terms of inheritance and gifting. Inheritance tax assessment in the UK is done on a probate administration. Any probate, when somebody dies, there has to be a tax clearance for that process. And that is the assessment for any capital gains on death or for an inheritance tax on death. If there is none, no probate, no administration, there's no inheritance tax, and there's no capital gains. This is our message to you. If you are UK resident or expat in the UK or expat abroad, if you don't own the asset, you can't pay capital gains tax. So it's about organising your assets to create your own family trust, your own family business, your own family investment trust that holds your assets. You don't need to own the property to live in it. You can rent a property and enjoy it. You can own it and enjoy it, but you can pay the taxes as well. The Duke of Marlborough, Arthur Wellesley, did a great service to the British Crown, defeated Napoleon. Napoleon ended up on his Mediterranean island at St Helena. I know it's Atlantic, but bear with me. Isolated and alone. Arthur Wellesley ended up being gifted most of Mayfair and Belgravia to create the estate of the Duke of Westminster. In theory, the richest man in Britain. The Duke of Westminster is not the richest man. They inherited the wealth in a trust. They've got access and use the value of the trust, the properties, the investments, the income, the fees for managing that family wealth, passed down the generations more than 300 years. Trusts can be taxable, but trusts are a separate tax entity. The UK government might change the way that trusts are taxed, but there's some international options where there are no taxes, no capital taxes, no inheritance taxes, and no income taxes on assets held in a trust, such as a Cyprus International Trust. And as a family office, PROACT can assist you and guide you to protect your assets, to avoid the cost and delay of probate, and to avoid inheritance and capital gains tax as you build up your business, as you build up your investments, and as you invest in property in the UK and around the world. Thanks a lot for listening. I hope you found it interesting. We're watching out and we'll keep you updated on wealth taxes and changes to capital gains and inheritance taxes coming up for UK expats living and working abroad. Thanks a lot for listening, and join us next time.